Right now, the United States government needs to find $10 trillion, and it needs it by the end of this year. That's not a projection. That's not a worst-case scenario. That is the actual amount of U.S. debt coming due for refinancing in the next 12 months. And the people who usually buy it are walking away. What happens next could reshape the global financial order. And almost nobody in mainstream media is explaining how we actually got here. To understand what's happening right now, you need to understand how the U.S. government actually pays its bills. The United States doesn't save money, it borrows it. Every year, the Treasury issues bonds, essentially I owe us, that investors, foreign governments, and central banks buy. In exchange, the U.S. promises to pay them back with interest. For decades, this worked perfectly. The dollar was the world's reserve currency. U.S. treasuries were considered the safest investment on earth. Countries didn't just buy them, they hoarded them. At the peak, foreign governments held over $8 trillion in U.S. debt. China alone held $1.3 trillion. Japan, the UK, Saudi Arabia, they were all in. The system worked because everyone believed the U.S. would always pay. And for a long time, that belief was justified. But here's the part that doesn't make the front page. When U.S. bonds mature, the government doesn't pay them off. It rolls them over. It issues new debt to cover the old debt. Think of it like taking out a new credit card to pay off the previous one. Over and over again for decades. That strategy works great when interest rates are low. When money is cheap, rolling over debt costs almost nothing. But rates aren't low anymore. Segment 1, the refinancing wall. Here's what almost nobody is saying clearly. The problem isn't just that the U.S. has $36 trillion in debt. The problem is when that debt is due. During the pandemic, the U.S. Treasury made a fateful decision. To keep borrowing costs low, they issued most new debt as short-term bonds. Bills that mature in 1 to 3 years. It kept the payments manageable in the moment, but that decision has a consequence they're now living with. Because all of those short-term bonds are coming due at the same time. Right now, in 2026. Over $10 trillion in U.S. debt must be refinanced within 12 months. That's roughly 28% of the entire national debt, due in a single year. And here's the brutal math. When those bonds were originally issued, interest rates were near zero. When the government rolls them over today, they're rolling them into a 4.5% to 5% interest rate environment. That difference doesn't sound like much, but on $10 trillion, it means hundreds of billions of dollars in additional annual interest payments. On top of the $1 trillion in interest, the U.S. government is already paying every year. For the first time in modern history, the U.S. government is paying more in interest on its debt than it spends on national defense. And it's about to get dramatically worse. Segment 2, the buyers are leaving. So the U.S. needs to roll over $10 trillion. Fine, it's done this before. But there's a problem it's never faced quite like this. The buyers are disappearing. For decades, the anchor buyers of U.S. treasuries were foreign governments, China, Japan, the EU. They bought U.S. debt because it was safe, liquid, and denominated in the world's reserve currency. That's changing fast. In the past 18 months, foreign central banks have dumped over $82 billion in U.S. treasuries, the fastest pace of selling since the 2008 financial crisis. China has cut its holdings from $1.3 trillion to under $760 billion in 3 years. Japan, still the largest foreign holder, has been quietly reducing too. The reasons are geopolitical as much as financial. U.S. sanctions policy has made holding dollar assets feel risky. Countries have watched how frozen Russian reserves were used as a foreign policy weapon, and they're asking themselves, could that happen to us? At the same time, domestic buyers, U.S. banks and pension funds, are already overexposed to treasuries. They can absorb some, but not $10 trillion worth. That leaves one buyer of last resort, the Federal Reserve, which means one thing: printing money. Every time the Fed steps in to buy treasury debt by creating new money, it does two things simultaneously. It keeps the government funded, and it silently devalues every dollar already in existence. Segment 3, the interest rate trap. Now here's where the trap snaps shut, because the Federal Reserve is caught between two impossible choices: to fight inflation which is still running hotter than the Fed would like. They should keep interest rates high. High rates slow borrowing, cool spending, and bring prices down. But high interest rates make the Treasury's refinancing problem catastrophic. Every time rates stay elevated, the cost of rolling over that $10 trillion climbs higher. The alternative? Cut rates. Make borrowing cheap again. That would reduce the refinancing burden dramatically. But cutting rates risks reigniting inflation, the very problem that's already squeezed American households for 4 years. So the Fed is trapped. Raise rates and break the government. Cut rates and break the currency. And the market knows it. Bond yields have been climbing even as the Fed hasn't raised rates, which is the market's way of saying, we don't fully trust you anymore. We want more return for the risk of lending to America. When bond investors lose confidence in a borrower, they demand higher yields. Higher yields mean higher costs. Higher costs mean more money printing. More money printing means more inflation. More inflation means even less confidence. This is called a debt spiral. It has destroyed currencies before, and the US is closer to the edge of one than at any point since the 1970s. Segment 4, History Doesn't Lie. At this point, some of you are thinking, this has to be overblown. The US has always figured it out. But history has something very specific to say about what happens when great powers hit their debt wall. The British Empire was the world's dominant power for over 200 years, backed by the pound sterling, the world's reserve currency of its time. After World War II, Britain was buried in debt. They owed the United States billions, and the cost of maintaining their global military empire became unsustainable. Within a decade, they devalued the pound, withdrew from empire, and handed reserve currency status to the United States. The dollar became king, but here's the pattern. Every reserve currency in history has eventually faced the same reckoning. The Dutch guilder, the Spanish real, the British pound. Each one fell not because of a single catastrophe, but because of the slow, compounding weight of debt no one wanted to acknowledge. Closer to our time, in 2001, Argentina defaulted on $100 billion in debt after years of rolling over obligations it couldn't afford. The peso collapsed. Savings evaporated overnight. Middle-class families lost everything in weeks. Argentina is a small economy. The United States is not, which makes the parallels both more instructive and more terrifying. The US has one advantage Argentina never had. The dollar is still the world's reserve currency. But that status is not permanent. It is not guaranteed by law or nature. It is guaranteed only by confidence, and confidence, once lost, does not come back slowly. Segment 5. What happens if it breaks? So what actually happens if the US can't find buyers for that $10 trillion, or if the cost of rolling it over breaks the budget? Here's what the models say. Scenario 1. The Fed monetizes the debt. They print money to buy treasuries nobody else will buy. This keeps the government funded in the short term, but it injects trillions into the money supply, driving inflation higher in an economy already stretched thin. The dollar loses purchasing power, imports become more expensive, the cost of living climbs further. Scenario 2. Yields spike uncontrollably. If the market decides US debt is too risky and demands dramatically higher interest rates, the government's interest bill explodes. Tax revenues can't keep up. Spending on Social Security, healthcare, and defense gets crowded out. Austerity politics, already simmering, boils over. Scenario 3, the one nobody wants to say out loud. The US misses a payment. Not a default in the traditional sense. The US can always technically print dollars to pay dollar-denominated debt. But a technical default, even briefly, would trigger a chain reaction through global financial markets. Every instrument priced off US Treasuries, mortgages, car loans, corporate bonds, reprices simultaneously. The Congressional Budget Office has already projected that without significant fiscal changes, U.S. debt interest costs will consume over 35% of all federal revenue by 2034. We don't need to wait for a crisis. On current trajectory, the crisis is already written into the spreadsheet. The $10 trillion refinancing wall isn't a theory. The buyers pulling back aren't a rumor. The interest rate trap isn't a prediction. These are numbers, published, verified, sitting in plain sight. The only question that remains is whether the people responsible for solving this problem understand the history well enough to know what happens when they don't. So far, there's very little evidence that they do.